Hey, this is Don Kaufman. Before we get to the weekend update, I would like to invite you to a session that is coming up this Tuesday, November 14th. Again, November 14th at 8 p.m. Eastern Time on how to trade volatility in the VIX. So there's a tremendous number of questions and a lot of misconceptions about really not only understanding the VIX, but trading the VIX. And during this session, I'm going to talk about, learn about trading volatility and how to create volatility-based trades. We're actually going to get to a detailed understanding of volatility. And really that detailed understanding can provide advantages in all of your trading strategies, including intraday trade. We'll also talk about how VIX options can help reduce portfolio exposure, whether it's a 401k, an IRA, okay, or a regular taxable account. And we're going to discuss really one specific strategy that you would really want to take advantage of in today's marketplace. Again, it's Tuesday, November 14th. To register for this, simply go to TheoTrade.com/VIX. TheoTrade.com/VIX. All right, let's get to that weekend update. Welcome to the weekend update here at TheoTrade. This is Don Kaufman. It is November 11th, 2017. Let's get started with a brief review of some of the action of this past week and what can only be described as quite a substantial expansion in volatility, which I'll show you here momentarily. And then we've got a lot to discuss in the coming week. So let's go ahead and get started here. Specifically, I'm going to start in the SPX, where again, we saw some action, some volatility, and what you're looking at on the screen right now are expected moves. Okay, now I've talked about these extensively. It's the option markets ultimately depicting what risk is forward looking. And when I say forward looking, and that's a really important portion of this, the lines that are drawn in your screen, and yes, we have an auto expected move indicator, which I'll bring up here momentarily. We just did, a webcast on that, and that was in this previous week. Nevertheless, I'm still going to continue to draw expected moves specifically on the SPX to make a few points in regarding to drawing them versus the auto expected move. Nevertheless, when you start looking at this, the important concept is the expected moves, they're already drawn for this coming week, right? So that's this next week, those expected moves are drawn already. And again, the expected moves are based on what we see in terms of options pricing. In this particular case, in the coming week, we've got about a $31 expected move. Now, as I said, I kind of wanted to do a bit of a review of some of the action of the previous week. Well, to get an idea of what I just termed an expansion in volatility, you have to recognize that what was expected last week, right, was right around a $22 move. And in the coming week, we've now expanded in volatility. And again, kind of highlighting this, when you think about volatility, well, this is just kind of charting it out, if you will. Here's a $22 move. This is now just over about a $31 move. So again, a nice expansion in volatility. Now, let's get right to it. The expected move starts, from a Monday, ends ultimately on a Friday. And again, the next one is drawn out for the coming week. All right. If you're not into the expected moves just yet, well, you really should be, because option pricing is not only depicting range, but it's also depicting where markets can have pretty substantial reversals. Allow me to take you into even intraday trade. So you say, where can expected moves be helpful? Expected moves can be helpful by selling premium and so forth, but expected moves can also be incredibly helpful even on an intraday basis. And I'm just going to kind of zoom out here for a second so you can see this. What you're looking at right now is the SPX, okay? That's the S&P index options. And here's the central point. The central point is only where the week ultimately started. So if you look at the expected move, all right, that's kind of where we started out the week. The lower band here is what the market anticipated the risk to be. That is, it anticipated a move down to about, 25.66. It literally touches the expected move to the penny and rips higher ultimately off of that. And again, if you're looking at this, you're like, all right, that's suspect at best, right? It's one product. Okay. But if you take a look at this, it's pretty awe-inspiring. But again, I'm a little bit more of a quantitative trader. And what that means, I would never go off of like, one indication here that it bounced right at the expected move. Okay, this is indicative of hedging activity. What happens is trading firms would have gone out and probably sold a bunch of, for instance, at the money straddles. And as we move to the edge of the expected, right, and I'll give you again kind of an example, this was a $22, again, a $22 expected move. So if you think about these expected moves, again, that range in here was about plus 22, okay, or minus 22. So if a firm goes out and they sell it, they'll sell the straddle and they'll actually collect about 22 bucks, okay, because the straddle and the expected move are very much one and the same. So they sell the straddle for about $22. When the marketplace moves to the edge of the straddle, they turn around and they start hedging very, very heavily with what? ES futures. And that, okay, on the dime can actually flip markets ultimately back around. It's hedging activity that drives right now most of what the S&Ps and what the SPX is doing. So to kind of continue this theme over here, just because we drew a line on the screen doesn't mean that we can't breach the expected moves. And that's of critical importance here. Like, of course, we can breach the expected move, but this is a probability of expiring. And there's a lot of skin in the game, right? There's a lot of traders, all right, that are ultimately going to fight the edge of the expected move. Let me show you another one here, albeit briefly, inside of the IWM. So in the IWM, I don't have any like lines drawn by hand. So in the IWM, I'll actually use the auto expected moves. And this is just a script written into thinkorswim. Now, here in the auto expected moves, you can see again, we've already drawn the expected move for the coming week, but take a look at this one. I mean, this one is awe-inspiring as well. We actually breached the expected move, and that's what those dots mean. We breached the expected move and ultimately came back inside of it. Remember, it's a probability of expiring. So if you think, again, the expected moves, don't necessarily, impact markets, of course they do. And it also gives you areas, people are into support and resistance and Fibonacci's. Well, listen, okay, this is drastically different. This is the options market depicting, okay, what the range should be. There's no directional bias to it whatsoever. All right, so we just showed, again, the SPX hitting the expected move and ripping off of it, the IWM hitting the expected move, breaching through it, but by the end of the week, ultimately coming back into it. It's also important that we look this past week at the QQQ. So again, we saw some sell-side activity. Again, we saw some sell-side activity in the S&Ps. We saw a little bit of sell-side activity in the IWM. As you saw, the IWM fell on the week. The Nasdaq, not so much. The Nasdaq ends the week slightly higher. However, okay, this is important. There's an expansion of volatility in the Nasdaq as well, and you need to recognize that. And I'll come back to that a little bit later, that there's been this expansion of volatility. Okay, looking around at what's going on in the overall market, there's a few big standouts out here. Not just that volatility is elevated, not that we just bounced off the expected move. Let's get right to the XLF, all right? The financials, they got rocked. Okay, we'll call it what you will. They got rocked this particular week on a percentage basis. And I'm going to kind of zoom in here. This chart that you're looking at is a year-to-date percentage. And here's a move. Again, ultimately, this is just 4 trading sessions where we were up just about 14% year-to-date. And there was a point where we were only up about 10%. That's a 4% slide. All right. Did this thing bounce over here? Well, no, it actually ended the week on a little bit of a down note. This is, to me, the most important takeaway from this previous week, okay, is that the financials are getting rocked. And the reason it's the most important takeaway, the financials are the stability of the S&Ps. Now, everybody is so focused. They're like, are you going to talk about Apple? Are you going to talk about Amazon? Are you going to talk about Facebook? And quite frankly, they didn't do much. And again, here's the conglomerate symbol for those. And I say they didn't do much on the week. As I start to zoom in, ultimately, they're massively unchanged on the week. They didn't do that much. Again, the focal point now needs to be, right, the XLF. It needs to be financials. And if you haven't seen this, again, so financials fell. Well, what happened? And anytime I see something like financials making a big move like this, and this is a decent sized move. Remember, they're the second largest, okay, of the sectors in the S&P. But arguably, okay, this is what drives much of the S&P trade. Clearly, the financials have a large impact as well on the Russell product, okay? Because the Russell and the small caps, there are a ton of financials. In fact, financials are the heaviest weighting into the small caps. So seeing the financials down should explain a lot about what damage has been done inside, ultimately, of the Russell. Okay, so we'll spin this back around for just a moment. We'll come back to the Russell here a little bit, a little later. But what's going on inside of the financials isn't even that much of my concern. As I said, though, it's one of the most pivotal moves, okay? My concern right now is what's going on inside of the bond market. And the reason this has got traders shaking their heads everywhere, okay? The bonds have been ripping higher lately. Now, as the bonds have been ripping higher, okay, these bonds, as they start to rally, that would take the yield, the interest rate associated with the bond, that would actually take the interest rate down. The lower interest rates, okay, those rates typically what? Hurt the XLF. So if you're taking a look here at the XLF, all right, so there's the bonds rallying. The impact to the XLF lately, it's been negligible. Like the XLF didn't have an impact when the bonds were rallying. All of a sudden, though, we see the bonds just getting rocked, literally, in 3 trading sessions, which takes interest rates, drives them back up. And yet, the XLF falls on the week, okay? Correlations are totally broken. This is the trade right now that should make everybody nervous. You know, about 2 weeks ago, I said the bonds are going to dictate the next move inside of the marketplace. And right now, the bonds, they're just getting scary, right? That's a really large move. And again, not everybody necessarily trades bonds, but a 2-point move like in bonds is big. But then you start looking at this at scale. I mean, from high to low over here, that's almost a 3-point move inside of 3 days. And that's some big boy stuff. You look back at the chart of the ZB. And the only reason I'm looking back is just to orient you with how large this move inside of 3 days really is. And it's quite spectacular. The bonds are also what I kind of call, they're trend worthy. Like, what does that mean? It kind of means when the bonds get on a tear, they tear for a long time. If this sell side activity continues very, very rapidly, okay, don't look at a rise in interest rates. So we're going to go to interest rates and explain this. So typically speaking, a rise in interest rates is good for financials. And I'll finish that kind of statement over here. Don't necessarily consider a rise in interest rates good for financials. Typically, a gradual increase of interest rates, very, very gradual, is phenomenal for the financials. And the reason is they sit there with, billions and billions of dollars of your money, and they make money off of your money, especially in a rising interest rate environment. However, interest rates exploding higher is detrimental to the entire economy. And that's why I said the most important thing to watch on your screen over here is the bonds this next week. If they really are trend worthy and this thing starts coming down to 150 or below, you got big problems at that point. And this might be the beginning of just those big problems. There is a scenario where we could see the bonds down big, financials down big, taking the S&Ps down big with it. And so the scary scenario then is, where does everybody go? Like if you can't, where are you going to rotate your capital? Typically speaking, what happens is, you're selling the S&Ps and you're buying bonds. Yeah, what happens if bonds and S&Ps sell off at the same time? They're going to dive into volatility products. And that's why we're going to be keeping a really close eye on some of the volatility products, all right? So bonds are off big. Now, let's give you a little bit more of a forward look, a feel for what's coming, if you will, this next week. All right, so we looked at the S&Ps and the S&P futures. They backed off a little bit on the week. There's nothing big. clearly we see some expansive volatility. Thursday there was a little action. Even into Friday, though, that action kind of continued. As I said, looking at the SPX, it's notable. The volatility in the SPX versus the previous week, it's right around 30% greater. So when you're looking at this and you're thinking to yourself, all right, so whatever, it's an expansive range. No, but on a percentage basis, you're looking at 30% more risk this next week than the previous week. That should be keyed into your trading throughout the course of the week. If you trade on an intraday basis, you should be paying attention right now. Why? Because you're supposed to get 30% more risk, which means 30% more price action. Okay? That should matter because how are you going to allocate? Well, you probably scale back allocations a little bit in the coming week, and that's what we're portraying with this. Okay, so for a moment, let's cruise over and let's look at option chains, because there's something interesting that I found inside of the option chains, and that was not only are some of the volatilities elevated this week, but the IV percentiles. Okay, and what is an IV percentile? It's a ranking, all right, of volatility. And I think the best way to kind of portray this is not necessarily like, oh, it's an IV percentile. There's one really interesting thing I was looking at a little bit earlier. I'm going to cruise down to a style. And one of the styles I've got, I just have the implied volatility pulled up for the last year. So don't worry about expected moves, none of that. This is in the Qs. This is in the Nasdaq. So what I found interesting about this, there's this gradual increase of implied volatility. It's just in the backdrop, but the underlyings are going up. So you have a situation, and we're through most of the big earnings, right? We have a situation here arising where, yeah, there's some big spikes of volatility in here. Those spikes of volatility, they're just like, oh, you had one wild down day and the volatility spikes up. But the notable thing is all the big tech companies, for the most part, your Apple, your Google, your Amazon, right? All of them have already reported. Why is volatility going up in the Nasdaq? Okay, with the marketplace going up? You need to think about this stuff. Risk is coming in as we're rallying. Okay, very peculiar. So now we're seeing the bonds are selling off and the financials are selling off. Well, that's not peculiar. That's just downright strange in every aspect. If you've looked at correlations, now we have the marketplace rallying with volatility going up. Wait, it gets better over here, because I took a little look at the IWM. And the IWM, this is interesting because the IWM has done nothing for the past couple of weeks. Broke down a little bit though, but the IWM is a very, very similar situation where the volatility has actually been taking off to the upside in here. And again, on a percentage basis, this is a pretty big move. And the marketplace is just now starting to teeter and fall in there. Last but not least, if you take a look at this inside of the S&Ps, okay, the S&Ps are also starting to see some elevated volatility. Again, I think the S&Ps, this is just simply reacting to what happened inside of the financials. But the most interesting, I think, to look at and to start to recognize is a gradual increase in implied volatility with the marketplace rallying. Okay, again, what it portrays is a picture of traders are getting more and more nervous as we move forward. Last thought on this front, okay? There have been some signs that I keep mentioning you need to look for a complete change of tone in the marketplace, okay? What are some of the signs you should look for? There's some individual stocks. One of the individual stocks that we've been looking at quite a bit, okay, happens to be Intel, okay? I've said this time and again, when Intel starts to turn and fall, okay, that's going to be all over but the crying in the Nasdaq. It has not. I'm not claiming a victory in here at all. It is not. It's starting to slide a little bit. Watch it this next week. When you have Intel start to fall, okay, it's been the marquee. It's been the poster child for this last burst to the upside inside of technology. And most people are kind of missing this. You're like, what do you mean? It was down 7%. Okay. Then it was up 28%. Yeah, that's a straight shot to the upside over there. I mean, even if you want to put it over here, this is where it was flat on the year. And we're talking literally a few weeks, and the underlying is up 30% inside of a few weeks. if Intel starts to fall, the market cap is large enough to start to hurt the Nasdaq. And that's just one individual underlying. Obviously, you can also look at, the conglomerate over here, but Intel is kind of the poster child for that last rally. The other aspect that you want to start looking at over here is, and I've mentioned this time and again, look at a handful of retailers. When the retailers, they start to buy these, then it really is all over but the crime, because one of the major trades, we're seeing them just sell anything, okay, in the retailer space over there. Sure, Walmart is actually, outperformed, but the retailers like Bed Bath & Beyond, okay, they started to get bid up, and especially started to get bid up on Thursday. And that's exactly what we expected to occur. If the marketplace as a whole starts to sell off, they're going to buy retail. Okay, and you saw it on Thursday when the marketplace did sell off a little bit. They bought Bed Bath & Beyond. Okay, now there's underlyings like Macy's as well, and Macy's, but it had earnings. But this thing takes back off to the upside over here, and it gets better. You could start looking through like Under Armour, right? Under Armour has had absolutely no love. Its earnings crushed it, but they're buying that as well. And I think you need to look at some of these retailers that just haven't been beaten down. They've been absolutely annihilated recently. A lot to think about. Again, key points here, expansion and volatility. Got to know that volatility has been expanding throughout the course of this week. It's one of the biggest takeaways. Okay, the next one, bonds, which are just, falling apart to the downside here as of Friday. If that continues, that is serious risk for the S&Ps. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.